Welcome to Option Trades Today. I'm Tony the Bat Batista, and I've got a trade idea for you today. December 14th, 2023, and let's see what's going on in the market. Even the S&Ps continue their climb, up $12. The NASDAQ actually down $16 for the first time in what seems like eternity, or if you can see here on the right side of the chart, about the last 6 days or so. Interesting thing, volatility futures rolled on Wednesday. They're up 10 cents, up 15 cents now to 14.35. We've had volatility stay bid yesterday and a little bit today, even with the market going significantly higher earlier today and maybe even catching a little bit of weakness today. Encouraging to me for a little bit of two-sided action that volatility is staying bid. Maybe we can get that maybe tomorrow. More than likely Monday or Tuesday. That's my guess because nobody knows the future. Volatility may be going higher. The rut is also going higher. Rut catching up to the NASDAQ, meaning the rut was a laggard for most of 2023. It is now catching up a little bit to the NASDAQ. NASDAQ selling off the last couple of days relative to the Russell. Does that mean anything to the overall market? Well, the NASDAQ's been the leader of the market, so maybe we're starting to get a little bit frothy. Who knows? Time will tell. AVGO is a stock I want to talk about today, up $21 and change. It just traded up to $1,119, up $21 and change. It was about $6 or $7 higher. Let's take a look at our little watch list here that we have. These are just high option volume. AVGO is in there. You can see that the IV rank is good, not great at 20, but look over here, the IVX 5-day change up 5%. Now, I did not do this list like I usually do it when I go here, looking at the IVDX 5-day change or the IV rank. I went by net change and then decided to look at what stocks have gotten ahead of themselves. Like you look at AVGO today up $20. Let's see how it's done over the last couple of days. And you say to yourself, wow, this stock has gone from 900 and change to 1100 and change. Is it overbought? I have no idea. Is it going higher? I have no idea. It started the year, somewhere around $600, and it's close to, it's over $1,100 now. Is it overbought? I have no idea. Is it fundamentally overbought? Is it underbought? Is it worth more than what it's trading? I have no idea. It's a $440, almost $450 billion stock. Is it worth $1 trillion? I have no idea, but let me tell you something. This move looks extended to me. So what I'm trying to do is go back to what we were just talking about a moment ago. Maybe the NASDAQ selling off. Here's a stock in the NASDAQ that has not sold off at all. Let's do a little bit of an omnidirectional, slightly bearish trade in AVGO to fit my assumption. Now, if it doesn't fit your assumption, meaning you think the market is going to continue screaming or the NASDAQ is going to continue going higher or AVGO is not overextended, then this is not going to fit you. But you should learn about this strategy because it's one that has a very high 80 or 90% probability of success. Let me tell you what I'm going to do. Typically, I go to January with 36 days, 45 days being optimal. I'm defaulting to February to give myself a little bit more time and allow me to go further out of the money with my spread. You look at the volatility between the 2 months, 30.4 and 30.5. They're exactly the same. Typically, you might find the front month is a little bit higher or the back month is a little bit higher. There's no disadvantage or advantage right now to go to January or February. I'm going to default to having time on my side because I believe time on my side gives me an advantage. So I'm going to February. 60-ish days is about as far out as I will go. I don't go out to the 90-ish day options. If you want to, that's entirely up to you. I would pick a more liquid product than AVGO to do that. But again, that's entirely up to you. What am I going to do? I'm going to do a broken wing butterfly, but I'm going to skew it just a little bit to go with my assumption. I get a lot of questions on, where do I place a broken wing butterfly? What I like to do is go somewhere near or around the 15 to 20-ish delta options. I'm going to go right now to the 1230 options. You'll notice that they're around a 23-ish delta. I'm going to buy one of those. I'm going to sell the 2260s. I'm going to sell two of those. So I've got an embedded $30 wide long call spread and short an extra unit of the 1260 calls. It's going to use way too much buying power, especially an IRA account, which I happen to be showing you right here. It's going to show a $93,000 buying power, way too much buying power for anybody's account in my mind, no matter how much money you have in your account. So I wanted to find that risk and also use less buying power. We did this today on the show at 9 o'clock on strategies for your IRA. I'm incorporating a little bit about what we talked about in practical applications for you here. What do I typically like to do? If I'm $30 wide, I like to go $60 wide with my next strike. If I'm $20 wide, I would go $40 wide with my next strike. So I'm $30 wide here. That means I have an embedded long call spread. That would be a bullish strategy. 1230 to 1260, $30 wide. 60 plus 1260 equals 1320. I'm going to buy the 1320 calls. Now, you can do this trade for around $1.25, $1.30, $1.20 credit. You'll notice the markets are a little bit wide here. If I was making this trade, I would go up at a higher price and then walk my strikes down. Walk my price down to a lower price until I get filled on it. But I have told you, I'm going to put a little bit of a skew on this. I want to collect a little bit more credit, and I also want to have a little bit more risk. Let's first look at this classic risking $2 to make $1 broken wing butterfly. This would be the classic way that I would do it, collecting around $1.20, $1.25, $1.30. Totally fits my parameters. I like to collect over $1. This completely fits. I want to take on a little bit more risk, but let's look at this one so we can compare the two. 89% pop. Love that. A small theta decay, $3.50, $4. I like that too. Small delta, -2, fits my assumption. My max profit, $3,120. How? That's that $1.20 I'm getting here. And if we were to close at $12.60, which I don't want the stock to go to, remember, I'm slightly bearish on the overall market. I don't think the AVGO is going to go, to this level. But if it did, I would make $3,125. My max loss is obviously going to be the credit that I received minus the width of the strikes, and that brings us to around $2,880. So I took my buying power effect down from $90,000-ish to $2,800. This is the way for those people who send me the emails. How do you trade a very high price stock that's going to use a lot of buying power, whether it's in a margin account or an IRA account? Now, I told you I was going to skew this. What do you think I did to take on more risk? Well, I have one of two ways I could have done. I could have tried to move this spread out, meaning move this wing out, use more buying power equals more risk. In its case, I get more credit, $2.50. But I've now gone up to almost $4,800 from $2,800 in buying power. So I've doubled the amount of buying power for about a double in the credit I received. I guess it's, 1-to-1, but for me, it seemed like it was too much risk. I'm going to go back to that 1320. What can I do? Give up a little bit of my potential gain for more credit received. So I'm going to move this 1230 to 1240, and you'll notice that it's trading around that same price. As a matter of fact, I got filled at $3.18 on this trade. $3.18 with the stock slightly higher than where it is right now. I bought the 1240, 1260. My pop went from 89 down to 88. My theta decay went up. My delta went up, meaning my delta, I got more short, fitting my assumption. My credit went up from $1.20 to $3.80, and my buying power went from $2,800 to let's round up and say $3,700. So I got significantly more credit for the amount of buying power I was using when you looked at taking more risk by moving out that short strike. So here's a little way where, yes, I can only make $2,300 instead of $3,000. But remember, I don't think the stock is going up here. I don't want it to go up here. So my credit I receive, giving up that extra $1,000 or $800 in potential profit to me is a small price to pay for the higher credit that I'm going to receive. Now listen to me. If you want to see all of these trades before this video even comes out, go to your Tasty Trade platform, click on the follow page, go down to Bob the Trader IRA, or just look for my smiling face up there, and you will see this trade already on here. When I made this trade, you'll notice I made it at 10:26 in the morning, that's Central Standard Time. I don't give you all of the background that you're getting on this podcast because it's just a sentence or two, but you'll notice it's an omnidirectional trade, a broken wing butterfly in a runaway stock. That's basically what I talked to you when I was talking about this whole podcast and the little color that I gave you behind the scenes. Why is it omnidirectional? Because I have no risk. If you see this green line, I have no risk to anywhere on the downside that this stock may go from approximately 1280 on down. So 1280 is my break even. That's what makes it an omnidirectional trade. 1260 is my max profit. My max profit is going to be that $2,300 or $2,300 in change that I can make. But really, what am I looking to make? I'm looking to make $1 or $2 on this broken wing butterfly. What am I looking for you to do? I'm looking for you to open an account at Tasty Trade. Watch me on the follow page. Heck, you can even watch Tom if you really want to do that too.